And we have seen some interesting reaction on the part of those who suddenly were sort of relieved and released, in the sense that we have seen a pickup of purchases of goods in particular, which was very unusual. And of course, the services now has been seriously accelerating, and we're using all sorts of unusual instruments to try to measure that. Mobility measurements in particular are clearly showing that people are going back to consuming services, and sometimes more than they had before pandemic. I would mention two of them. The first one is the supply bottlenecks and the disruption of supply chains, which we have been experiencing now for a few months, and which seems to be continuing, and in some sectors accelerating. I'm thinking here about shipping, cargo handling, and things like that. And clearly, if we look at some of the exporting countries in the euro area, they would have been able to export much more goods than they have because of these issues. The second point that I would like to mention, because the euro area is a net importer of energy, is the significant increase in the price of energy pretty much across the board, led obviously by gas, by electricity, by oil to a certain degree as well. But those are sort of base effects of what we saw last year, which was a major decline of those prices.
Over the last couple of months, the Delta variant has held up progress, keeping people from resuming public activities in the travel and leisure sector. Job growth slowed sharply, and estimates of third quarter GDP have come down, albeit still to strong levels. Bottlenecks and tangled supply lines are holding back activity in some goods, particularly automotive. And the combination of strong demand for goods and the bottlenecks has meant that inflation is running well above target. It is frustrating to acknowledge that getting people vaccinated and getting Delta under control 18 months later still remains the most important economic policy that we have. And it's also frustrating to see the bottlenecks and supply chain problems not getting better. In fact, at the margin, apparently getting a little bit worse. And that's what we see that continuing into next year probably, and holding inflation up longer than we had thought. But ultimately, the outlook for next year among my colleagues and me at the Fed for next year is quite a strong year, with growth well above trend and unemployment reaching significantly lower levels than now. For some time, we and others have been forecasting that the current inflation spike will not lead to a new inflation regime in which inflation remains high year after year. In other words, that is what we mean by saying that the spike will be transitory. We don't mean that prices will come down. What we mean is that this inflationary spike will not lead to a new regime of ongoing higher inflation. As I mentioned, economic forecasters and pricing in financial markets are well aligned with that perspective. And why is it our perspective? It's really because the current inflation, as I mentioned in the beginning, the current inflation spike is really a consequence of supply constraints meeting very strong demand.
At the moment, we are certainly not seeing any widespread contamination, so to speak, of those price increases into wages that would produce the second round effect that we would be very attentive to. So we monitor carefully, but we certainly have no reason to believe that this price increases that we're seeing now will not be largely transitory going forward. We started in the euro area from a different base. We are at different interest rates. Ours are certainly for the DFR negative, and we have asset purchases that are underway and will continue to be so until we are confident that we reach the level that we have set for ourselves.
Pretty much in every cycle, we just tend to underestimate the damage and underestimate the need for a response. I think we've avoided that this time.